Welcome to the Micro-Cap Brief. Why do so many micro-cap stocks end up going to zero? It's because they operate in a high-risk world of low liquidity, limited information, and a constant threat of manipulation. Investing here isn't about finding winners. It's a defensive game of avoiding the 99% of companies that are destined to fail. Success requires a system, a filter. Today, we are opening a playbook and giving you a 5-step forensic framework, a sequential checklist designed to kill a bad investment idea before it costs you your capital. This process is sequential. A failure at any step is a deal breaker and terminates the analysis immediately. Let's begin. Step 1. The survival check. This is the existential test. Before we look at anything else, we must answer one question. Will this company be in business a year from now? We find the answer in the company's latest quarterly report, the 10Q. First, we perform a forensic calculation of the company's cash runway. The most honest measure of a company's operational health is its free cash flow. This is the cash generated from its core business minus the essential spending on long-term assets. To find this, go to the statement of cash flows. You take the cash flow from operations and subtract capital expenditures, which is the main component listed under cash flow from investing and is usually called purchases of property and equipment. This gives you the true cash burn. Once you have the monthly burn rate, you divide the company's current cash balance by that number to get your runway in months. A company must have a runway of at least 12 to 18 months to pass this check. After you know the burn, then you can look at the cash flow from financing section. This tells you how they're plugging the hole. Is it through debt or by selling massive amounts of stock, which is a red flag we'll cover in our next step. Second, while in the filings, we search for the ultimate red flag, a going concern warning. This is an official opinion from the company's independent auditor, stating there is substantial doubt about the company's ability to survive. If you see this warning, the analysis is over. You walk away. Step 2. The dilution detective. If a company can survive, we next perform the abuse test. We need to know if management has a history of destroying shareholder value. First, we look for a history of multiple reverse stock splits. While a single split can be a strategic necessity, a pattern of repeated splits is a massive red flag, signaling a chronic failure of the business model. Second, we look for the most toxic form of financing, death spiral convertible debt. These are loans that convert into stock based on a fixed dollar amount, not a fixed number of shares. This creates a devastating feedback loop of dilution that is almost guaranteed to drive the stock to zero. If you find this in the filings, the analysis is over. You walk away. Step 3. The agency litmus test. If the structure is clean, we move to the agency test. Do the actions of management align with the interests of shareholders? We find the answer in the SEC's Form 4 filings, which track insider buying and selling. We ignore the noise of automatic grants and options exercises. We are only looking for 2 specific transaction codes. The first is code P for an open market or private purchase. This is the strongest signal of confidence, showing an insider is using their own cash to bet on the company's future. The second is code S for an open market or private sale. A pattern of insiders dumping their shares is a clear warning sign that they believe the stock is overvalued. Step 4. The hype versus reality check. If the insiders are aligned, we perform the veracity test. This is where we look for signs of pure promotion and fraud. Be extremely wary of companies that frequently change their name, business focus, or ticker symbol, as this can be an attempt to hide a failed history or chase a hot trend. Be cautious of stocks promoted through unsolicited emails or social media hype. And if a company has ever had its trading suspended by the SEC, it's a sign of extreme risk. The core of this step is to compare the story the company tells the public with the reality it discloses to its lawyers. You take the bullish claims from press releases and compare them to the cautious, defensive language in Item 1A, Risk Factors of the company's 10-K. The Nikola fraud case is the perfect example. Press releases screamed about billions in pre-orders, but the S-1 filing legally described them as non-binding reservations. That discrepancy was the key. Step 5. The catalyst for change. Only if a company has passed all 4 of these brutal exclusionary filters can we finally ask, what is the opportunity? A viable microcap investment requires a powerful, specific, and credible catalyst that will fundamentally change the company's future. Vague hopes about a better economy are not enough. We are looking for concrete structural changes. This could be a new, proven management team with a track record of successful turnarounds. It could be the launch of a truly differentiated product that is now generating real, verifiable revenue. Or it could be a high-barrier milestone like an FDA approval or a major multi-year binding contract that guarantees future cash flow. The catalyst must be real, measurable, and happening now. This 5-step risk-first framework is your greatest defense. By proving a company can survive, has a clean structure, has aligned insiders, tells the truth, and has a real catalyst for change, you can systematically filter out the vast majority of traps and focus only on the highest quality opportunities in the microcap space. Before we go, a final and important reminder. The content in this video is for educational and informational purposes only. It is not and should not be considered financial or investment advice. We are not financial advisors. The companies discussed are historical case studies, not a recommendation to buy or sell any security. Always conduct your own thorough research and consult with a licensed financial professional before making any investment decisions. Thank you for listening to the Microcap Brief. Do your own research and invest wisely.